Hey everyone, it's Imran from Options Insight back with another macro options spotlight. Okay, another bad week for stocks last week, closing out on the back foot, repricing obviously in the rates market on the back of PCE inflation coming in hot, and that took the S&P below that key 4,000 area and tested those moving averages down in the 39.50 zone. Did manage to hold on and have a rally into the close, but some technical damage potentially done. We're going to have to see how that plays out this week. Europe and China also weak. China down. No hard data really. The hard data in China, not turning up despite liquidity injections from PBOC. So we're not really seeing what we would like to see in terms of stimulus there to really get that China reopening narrative going. It's kind of been fading for quite some time now, since sort of middle of Jan. And then Europe finally getting the memo on the sell-off and actually having a bit of a bad 1.5 sigma down day on Friday and closing out the week down around 2%. And that's the most weakness we've seen in Europe for quite some time. And if that is going to catch up to some of this China fading of optimism, then Europe may have quite some way to go because that's been outperforming on a lot of different measures. Looking at metals, we did see them remain weak. Gold, miners, and silver down, but copper also breaking below that key $4 level that we've been looking at. So that may well have some further downside, again, dragged down by the kind of weakness in China. But if you look at energy commodities, both nat gas and oil managing to show some relative resilience, nat gas bouncing 10% and oil managing to stay flat on the week, despite what the dollar's been doing. Looking at vols did pop. We saw nearly a 3 vol pop in US indices, but Europe and China not far behind. Now, even though we got this big vol move in terms of on the week, fixed right vols were actually slightly lower. So obviously with skew going bid and vol going bid over the last week or two, there's quite a high hurdle for the markets to trade lower and for fixed right volatility to go higher. So, in our weekly reports, we show our fixed right monitor there, but just highlight there that fixed right vols are down about half a vol in the front end of the curve on S&P. So showing that there may be some exhaustion to this sell-off and dealers not needing to reach so much for vol in the face of a 3% down week. Now, Nikkei vol does stand out. It was down last week, stands out as the cheapest at 15 vol if you ignore FTSE. But FTSE on a 13 vol actually is expensive, given that it realizes 6. But Nikkei being on a 15 vol and kind of realizing what it needs to with flat carry is looking like one of the cheaper vols right now. And if you think there's going to be some shenanigans out of the Bank of Japan in the not too distant future, then you may want to scoop up some relatively cheap Nikkei vol. Commodity vols were supported on the week. They were all pretty flat to up. The best bids coming in uranium and oil vol, which were both up 1.5 and 2.5 vols a piece. Like I said, on the carry side of things, generally equity indices were in positive carry. Europe really being the main one. Again, FTSE especially with a 50% positive carry. And US indices, whilst they were in the green, not quite as much juice to extract there because they are still moving around. They seem to be leading the movement. And then in commodities carry, we've got precious metals obviously quite positive still. As we're selling off, we're not selling off with any real velocity. So we seem to be slowing down the sell-off as we're approaching that 1800 area that we've been citing on gold. And that maybe is a positive sign that if you can't sell off and pick up realized vol on the way down, realized right now in gold at around 6.7, which is pretty low, suggesting that maybe this is getting a bit long in the teeth, this correction in gold, and we may be in for a bit of a bounce. And then lastly, copper in deep negative carry here. Copper's been having some pretty wild swings, 3% up and down a bit more regularly. So that thing there, potentially at 25 implied vol, is quite good value, given that we're in negative carry territory. Skew-wise, we did see US skew stable on the week, but it did pull back from its highs intra-week. European skew, on the other hand, exploding higher, and that is reaching kind of median levels now in Europe, which is the highest we've seen since October last year. And in commodities, the standouts in skew are silver, which is the 99th percentile, showing a put premium where it normally lives in a cool premium territory. So that looks quite expensive for puts in silver, as silver has been quite weak. So for those of you who are brave enough or who have the dry powder to sell downside puts in silver, looking interesting. And then nat gas in the 98th percentile, obviously that's been super weak, even though it bounced 10%. it's still showing an 8 vol premium for puts, as it's hard to really know when this thing's going to find a durable bottom. Okay, on to the charts that we're looking at here. Obviously, the PCE data that the Fed does anchor on came in hot on Friday, triggered a bout of selling in stocks. Terminal rates are now at a new cycle high at 5.42 as we currently look at it. SPX broke below I put the 400 there, but that's a 4,000 level, testing support of 39.50, which did hold. Spot gammas indicators, obviously in real time, these guys track what's going on in terms of the option flows. You can see here, whilst we sold off, bounced, sold off, this blue line represents what's going on in put flow. So from the second half of the day, we saw this big increase in put selling. So that's the delta increasing. That's why the line's going up. And because it's blue, it's the put. So how do you increase delta inputs? By selling them. So we're seeing monetization of puts from, early on. We saw a little bit of it at the start of the day, but it really accelerated in the second half of the day. And that's what really kind of helped markets bounce as people were taking puts off. Obviously, markets have been weak for a couple of weeks now. So people who got into those puts early were incentivized to take some money off the table. Now, we have got month end this week. There's going to probably be some rebalancing flows, but because it's not a quarter end, that might not be that big. It does seem that CTAs are still in selling mode. If we stay below the 4,000 area, that was there's lots of CTA triggers below that level. We also see a reasonable amount of options rolling off on Tuesday's expiry, which is month end. And those seem to be charming positively. So as you get close to expiry, remember there's this charm where the deltas of options are changing through the passage of time. And it does look like that's a positive net effect, which may provide some short-term support to the market, similar to what we saw in the Feb OPEX on the 17th, that markets couldn't really sell off, even though the macro was looking worse. We may see that today and tomorrow. So you're seeing again overnight, S&P futures have rallied slightly. So we think this charm effect is probably supportive. But once that goes away on Tuesday, we then may see some more weakness. Obviously, ISM services on Friday is likely to provide some rates volatility and set the tone for the next material move in risk assets. Obviously, if that number comes out strong, then that's probably going to make rates go higher and probably make equities go lower. We did take the opportunity last week to cover some shorts. Subscribers to our weekly product and our trade alerts will know that. But we still remain overall defensively positioned, waiting for clearer signals through what has been, in our view, quite a lot of noise lately. So we're happy to kind of take the book a bit closer to neutral and wait for opportunities there. Okay, in terms of opportunities, one thing that's on our radar is defensives, or particularly healthcare. So if you look at XLV, which is the healthcare sector, you look at a chart on that, it's had a pretty decent drawdown from its highs made in December, Jan. And the structure as well does look like a potentially a complete correction where you've got like an A, B, C type move. And it's gone right into the retracement zone, Fibonacci retracement level here around 128. Now, also the fact that it's defensive, right? These healthcare names are defensive. The market's kind of now questioning, are cyclicals still the way to go with China optimism fading? There's been a lot of tech short covering going on. Defensive longs are getting sold, hence why healthcare is suffering. And is that rotation going to come back if broader markets do continue to sell off as rates go up? Because if rates keep going up, then tech's probably going to get sold again, and people might want to rotate back into some of these more defensive sectors. And finally, is energy going to work again? Energy's been pretty poor so far this year. It outperformed last week, being flat in a week tape. So maybe people are going to move back towards there. So again, signs of potential rotation. So something that we spotted in our weekly analysis was that if you look at XLV, and this is a realized skew analysis that we do. Okay, a lot of people ask me to explain this a bit further, but basically realized skew, what we're basically doing is we're saying, where has spot been and where has vol been in a particular asset over the last 3 months? And so for every observation of on any given day, implied vol is at a certain level for an asset at the money implied vol, and spot is at a certain level. And that's what all these colored dots represent. These colored dots represent spot and vol observations over the last 3 months. And then we split them, we color code them into the different months. So the green is the last month, the blue is the month before, etc., etc. And then what we also do is we have these curves that are slicing through. And those curves are the implied skew surface currently, a month ago, a month before that, and a month before that. So what we're trying to ascertain is how was the skew surface priced from an implied vol perspective, and then what actually happened. So this is similar to when you look at realized vol and compare it to implied vol. Implied vol is how vol is priced. Realized vol is what just happened. This is the same thing. These curves represent the implied skew and where the market believes vol will be at different levels of spot, but the dots represent where vol has actually been for the different levels of spot. So that's what this realized skew analysis is showing us. And with spot down here, we're currently here on XLV. So the vols are around 15.16 and the spots are around 128. Now, the interesting thing is this upside here is pretty much lower than all of the observations of vol and spot when the market was higher. So when the market was in this region here, that's where all these dots are basically between 130 and 140. The implied vol was anywhere between 14 and 20, right? So that's the range. The range of the vol is from there to there, and the range of the spot is from 130 to 140. So what we noticed is this green line has taken the upside vol on XLV to a pretty cheap level. So you can own upside calls in XLV on around a 13 implied vol, and that's about as low as it's been for months. And so what we're thinking is that if you tactically want to buy the market here, and that's your choice, whether you think the market's got further downside or you think it's due a bounce, we think this defensive weakness that we've seen could easily reverse as people rotate back into the more defensive names, and you might get a bounce out of this sector. And the way you would play that is by buying outright calls, which from a vol perspective look quite cheap, because as the market has sold off in XLV, the skew has steepened. And you can see that from these lines were quite flat, like the blue line is quite flat and the green line is much steeper. So that upside volatility that we're talking about has collapsed and has got to much cheaper levels. So that's what we've noticed through our skew analysis. And so the trade that we are thinking about doing after looking at our dashboard, and you can see here, our dashboard obviously is screening as buy calls. Which calls would you buy? Generally, we're looking for just a tactical bounce. We're not so sure that the market's done selling off yet. So we think in the short term, you could get a tactical bounce, particularly back into defensives. So we'd go for the front end of the curve. So something like March or April. It's a fair amount cheaper than it was about a month ago. It's obviously richened in the last week, but because that upside, because the skew has gone up to here, that upside is actually not really moved, and that upside's still quite cheap. So the type of calls that we would be looking at. Okay, that's it for today. Thanks a lot for listening as always, and I'll catch you all tomorrow.